Today, I'm going to run through how I conceptualize property markets. So just some opening thoughts. I think there's numerous ways of viewing property markets and understanding property. I think my lens is a bit institutionalized, and that really comes from being trained up as a property valuer and learning a very systematic way of understanding property. I think as a valuer, you're trained to understand the value of a property at a certain point in time. And I think it's quite different to property investment, whereas as a property investor, you're kind of viewing it through a more of an economics lens and trying to project the future growth of that location and ensure that the economy of that area is going to do well over time. I would also just say that I feel like there's quite a big difference between working, as a property consultant and actually having skin in the game and owning investment properties. And it's kind of interesting within the property valuation space, you have people valuing like $50 million warehouses and they've never owned a warehouse themselves. Just an interesting observation. So anyway, at the heart of property markets, obviously they're going to be dictated by supply and demand. And I think thinking about supply and demand is probably the simplest way of, conceptualizing property. But I think it is helpful to unpack supply side and demand side factors to get a more defined picture of property markets. And then towards the end of this video, I want to touch on some principles from property valuation and the commercial property sector, which looks at conceptualizing property through the lens of it being an asset with a cash flow. Obviously, a little bit contentious viewing housing through the lens of it being an asset with a cash flow. But at the end of the day, that's kind of how our society is set up and how we as a country choose to view property. I personally probably think that housing shouldn't be an asset, but I guess that's the game. Don't hate the player, hate the game. So touching on supply and demand, everyone's seen this classic sort of supply and demand graph. I've tried to list some supply and demand factors that I think are relevant. So on the supply side, I think we have stock levels, available land supply, construction costs and capacity, planning and regulatory processes, developer feasibilities. So does it make financial sense for developers to deliver new stock? And then also government policies like delivering public, social and affordable housing, that non-market sector of housing supply. Some of the demand side factors that I've sort of listed: if an area is affordable for the local incomes, that creates demand. Credit and monetary conditions. So lowering the interest rate obviously means that you can borrow money cheaper, and the way banks assess you as interest rates decrease, your borrowing capacity should increase. There's also government incentives and policy. Big one recently that everyone's talking about is the first home buyer scheme, which is basically allowing first home buyers to put a 5% deposit down with no LMI. On government policy as well, negative gearing and capital gains tax discounts. These policies obviously stimulate investment. Investment is another item on the demand side equation. So obviously investors are a segment of the demand for housing. In a recent video, I looked at new loan commitments. Basically, 38% of new loans were to investors. That was some ABS data. I think it was sort of June 2025. I mean, this next one's whatever, but market sentiment. I think humans are ultimately emotional creatures. And if sentiment shifts, then, that creates more demand. I have exchange rate on my list as well. So the Aussie dollar has been really weak for a few years. And I guess that essentially means that, people who migrate to Australia, maybe their currency gets converted into, a larger amount of Australian dollars, or international investors investing in Australia becomes more attractive. There's population and migration. So obviously more people in an area means more demand. I also have yields and mortgage arbitrage. So what I mean by that, an example would be, parts of Melbourne recently, they typically had gross yields, around 3%. those yields crept up into the high threes, and those yields were increasingly more attractive for investors, I guess. Within Melbourne as well, why those yields increased is because rents within Melbourne increased quite substantially as well. And what I mean by mortgage arbitrage is, if your rent increases a lot, you might sort of assess what you're paying in rent and what you would be paying for a mortgage, and you might find that it's cheaper to buy than rent. This was quite a big factor in COVID when interest rates were at record lows. Lots of people were finding that with a mortgage, it was cheaper to buy and pay the mortgage payments than rent within Melbourne. We had a 0.1% cash rate, so I think the interest rate on a mortgage was around 3%. So the low cost of capital just fueled demand. And then I also have income growth and employment opportunities. So if incomes within a particular area grow, that's effectively going to mean that all the people within that area have more firing power to bid for housing. And from a recent video of mine, the actual growth in incomes ultimately gets captured by land values within an area. People's incomes rise, and so does the cost of housing within that area. What's also relevant within this demand equation is just money supply growth. So the money supply is constantly increasing. And a key example of this is, you look 20 years ago, a can of Coke was, $1. And a can of Coke now is probably $3. But what you also have to think is 20 years ago, the median wage was probably, 40 grand or something. Now maybe it's, 90 grand. So every year you're going to have a little bit of wage growth. So I've just gone to the ABS website and you can see annual wage growth by sector, seasonally adjusted. You can see in some of the worst years, the average wage growth has been, around 1.5%, but it's generally around, sort of 2.5% per annum. So if wages are just growing, steadily at around 2.5%, then that should be absorbed in the nominal prices of housing. So moving on, just wanted to give a bit of an example. If you have a huge increase in demand, maybe you've got a lot of population growth and wages increase, that demand curve is going to move to the right, and effectively houses will become more expensive. Another example, if we get some improved construction methodology, so say modular builds get way more efficient and they become really cheap, and the construction sector can provide really cheap, fast housing in the form of modular, or potentially humanoid robots get really good and replace tradies, then what you might find is that supply curve moves to the right as well. And if you get massive deflation in the construction sector, then maybe you'd see the price of houses moderating. This is a huge theoretical, and I do not see this happening within the Australian construction environment anytime soon. In reality, we actually have the opposite. Construction prices have increased, around about 50% post-COVID. So that supply curve is moving to the left, if anything. Another example could be Australia becoming less transparent, and increasingly corrupt. And that would probably reduce demand for investment in Australian real estate. So quite interesting. I've recently done sort of PK's property investment course, and his sort of framework for thinking about property is really looking at the supply and demand, but starting at the very high level at the sort of Australia-wide level. And I think we take for granted that Australia is a very politically transparent country, and there's quite a lot of demand to migrate to Australia. And he kind of zooms in on the supply and demand situation at like a state level, and then a region level, and then, at a local street level. Definitely an interesting course that's worth doing. So just touching on my lens through which I view property and kind of the key things that I like to focus on. So I'd say I'm kind of a medium risk investor. I'd be happy to, and I have invested in some of the larger regional centers, but I want them to have a strong narrative behind why people would actually want to live in those regional locations. I think I'd be a lot less comfortable investing in small towns. Not to give any sort of hard and fast population numbers, but I probably want to be investing in places with populations higher than sort of 25,000 people. I don't know, just plucked that out of thin air. But for me, there has to be a narrative behind why I'd want to invest there. What does the local economy look like? Where are people employed? Are there any headwinds or tailwinds behind the economies? Could you live in those large regional hubs and commute to a capital city a few days a week? I like to look at yields as well. And I'm looking at yields in a wider context. It's not that we're specifically targeting high yields or avoiding low yields. I'm trying to look at that property market and decipher what the market is thinking about that location based on its yield and its historic yield as well. Like when you look at yields, what you'll probably notice is that Geelong and Ballarat have much tighter yields than a Bendigo. They sit about a percentage point below Bendigo yields generally. Maybe that was the case 6 months ago. I know Bendigo has moved a lot over the last year, but that's effectively the market saying that they see investing in Geelong and Ballarat as being, effectively less risky than Bendigo. That may not be the case. That's probably just the market's perception. But effectively with yields are basically the market pricing the perceived risk of, tenants and the perceived capital growth of a location into that number. And that's why you see tighter yields in blue chip locations than on the fringes of cities, where in those blue chip locations, the market is perceiving them as being less risky, and the market is willing to accept a lower yield for those properties than the properties on the outskirts of the city. So again, with yields, parts of Melbourne, typically 3% yields, they were sort of touching 4%. That's because the price of houses sort of stagnated since 2022. Rents were increasing, vacancy rates were coming down, and the market was effectively repricing Melbourne. Lots of negative sentiment in Melbourne. They'd made some changes to the land tax rules, and the market came to its senses and kind of came to the conclusion that a 4% gross yield is very attractive for particular parts of Melbourne. Parts of Frankston were touching that 4% yield, and yields are coming down with that interest rate decreasing. I also like to look at vacancy rates. So effectively, having a tight vacancy rate really indicates that people want to live in that area. If you have a sub 1% vacancy rate, it shows that there's demand to live in that area as a general rule. Caveated with the fact that you have a normal amount of sort of rental properties. So when vacancy rates are low, this is also effectively going to drive rental growth. And it's kind of the classic story, Adelaide, Brisbane, Perth, they were quite affordable compared to Melbourne and Sydney. Lots of infrastructure spend, good jobs in the mining sector in WA. So lots of people migrated to these areas. Vacancy rates tightened up, rents grew, and correspondingly, you've seen a big growth in house prices as well. And again, just feeding into the narrative, I think there has to be some sort of story around housing affordability. Depends what sort of metric you want to use for housing affordability. If interest rates decrease, then, effectively housing affordability increases because your mortgage payments drop. Or the example that I just gave, Perth, Brisbane, and Adelaide were looking very affordable in the past years compared to Melbourne and Sydney. So people moved to those locations to have a better lifestyle. Finally, I also just like to look at the supply potential of an area because supply may act as a drag on price growth. I think this is a bit less of a concern recently because developers are having a hard time producing new product. Doesn't financially make sense in a lot of cases. Some of my recent videos, it probably costs about $700,000 to produce a 2-bedroom apartment, and developers probably need to sell it for, around $900,000 to turn a profit. And house and land packages, you look at some of the greenfields estates in Melbourne, probably at the very low end, you're looking at, a $750,000 house and land package, probably a small house on a small lot as well. But I do think that when the price of existing stock increases, there'll be a point where it makes sense to develop. And at that point, more supply will come to the market. But I also think at the same time, with a lot of these greenfields housing estates, which are going to be the risk from a supply potential generally, a lot of the time they're away from all of the established amenities. So you look at a suburb like Werribee or Hoppers Crossing, you've got a lot of established amenity around the train line, and then the greenfields housing estates, they could be 5Ks away from the train station in fundamentally a worse location away from the established amenity and infrastructure. So I think fundamentally, if you're trying to purchase as close to that established infrastructure and amenity as possible, you're going to have more of a scarce asset than a house within a housing estate that's identical to all of the supply around it. So kind of at a high level, that's how I view the property market and sort of property investment. Later in the video, I also want to touch on property as an asset with a cash flow and that lens of conceptualization, but I want to give an example now. So I want to look at the narrative of Bell Park, which is a suburb within Geelong. So Bell Park and Geelong made a lot of sense to me from a narrative perspective earlier in 2025, and it probably still does to some extent. So effectively, you could buy a renovated modern family home on a large block for the mid 600s in early 2025. And Bell Park was an established landlocked suburb, sort of 5 to 10 minutes from the Geelong CBD, multiple schools in the area, a large hospital in the vicinity, the McKellar Centre. Easy to get into the Geelong CBD. You've got the rail infrastructure to commute to Melbourne if you need. You've got that optionality to work in Geelong or work flexibly in Melbourne. About a 1 hour commute, probably a bit more. I thought I'd just quickly pull up the H-tag page for Bell Park. So it's currently saying the median house price is $625K with a 4.07% yield. I find it really hard to interpret the graphs on H-tag. I wish you could kind of zoom in on them a little bit, but you can see that yields sort of bottomed out in that COVID era when interest rates are at record lows and they've sort of steadily increased. H-tag saying an ersatz of 3 out of 10, so the bottom 30% of sort of socioeconomics, 31% renter to owner, 35 years of affordability. I'll show you my own sort of affordability calcs soon. It's an established landlocked pocket, so there's, not many building approvals. Vacancy rate is pretty tight at 1.68%. So I'd probably just cross-check that with SQM. So you can see SQM, the asking price graph. Let's just do all houses. Been flat since 2022 thereabouts, trending up recently. Rents have been steadily increasing. They have vacancy rates at 1.1%, so very tight. And they have gross yields for all houses in the area at 3.5% and 3 bedrooms at 3.7%. But this is the postcode and it probably includes some other areas. So what I wanted to actually show was this sale in March 2025. So it was a renovated 3-bed, 2-bath, 2-car property, brick dwelling on 650 square meters of land. Looking at the map, you can see quiet street, regular shaped block. We've got North Geelong train station in the vicinity. We're not too far from the Geelong CBD, probably 5 or 10 minutes away. We've got multiple schools in the area within walking distance. And we've also got the McKellar Centre, which is this massive hospital down here. So basically family home, $675,000. Just look at the photos, very modern. Studio out the back as well. Big backyard, regular shaped block. House is in great condition. Floor plan, quite a regular floor plan. You've got large family rooms. You've got the 3 bedrooms, ensuite in the master, and additional bathroom and laundry. So $675,000. For that price, you barely get an apartment in metropolitan Melbourne, and a more recent sale in September 2025. So you can see same land area. This one's number 61 Bruce Street, and the other one was 60 Bruce Street, and this sold for $680. So you can see same land area, quiet street, regular shaped block. This one's a 3-bed, 1-bath. The other was 3-bed, 2-bath with a studio out the back. And this one is not renovated. So you can see original condition, bathroom looks okay, big backyard, regular shaped block. So you're effectively getting less bang for your buck today, which means that the market has uplifted. People are paying more for a worse property. Just shows that the market is moving. So just using that first property in March as an example, I want to run the plumber and nurse test. So I conceptualized basically, a family or a young couple. One's a plumber, one's a nurse. Could be a modern couple where the husband's a nurse and the wife's a plumber. I'll leave it up to you to decide. So I just Googled some salaries for plumbers and nurses. So nurses were sort of 70 grand to 105 grand. Let's call it 90 grand. Plumbers, 80 grand to 100 grand. Let's also say 90 grand. So total household income of 180K gross. Purchasing the property for 675. I would have actually thought that plumbers would be on higher salaries than this these days. So on this purchase, the price to their income is 3.75 as a ratio. They'd be paying sort of $37,000 in stamp duty, thereabouts. Just assuming that they're not taking on the new first home buyers incentive, assuming they're putting down 20% equity, they're putting in $135,000, taking on 540 grand in debt. What would their annual mortgage payments be? So looking at a P&I loan, 30 years, 6% rate. We're kind of just modeling it for, March of this year. So about $39,000 per annum equates to about $750 a week. And those mortgage payments as a percentage of their gross income is around 22%. Just looking at what's for rent currently, I thought that the property would probably rent for around $525 per week, which is a 4% yield on purchase. So you can see by purchasing, they're paying slightly more per week, about $250 extra, but the house is relatively affordable for their income. And generally if you're paying over 30% of your gross income on your mortgage payments, you're in mortgage stress, bit of just a rule of thumb. So basically for this section of the video, I think there's quite a strong narrative for Bell Park, Geelong. When you dig into the numbers, it makes somewhat financial sense. Get a better lifestyle than Melbourne, relatively affordable for a plumber and a nurse. I mean, you still have to come up with that deposit. I'm familiar with Geelong as a city. There's quite a large amount of infrastructure investment. You've got the new Geelong Convention Centre being built. Lots of the big consulting firms of the city are setting up a Geelong office, and lots of people have sort of moved down there with flexible working, my sister included. So effectively that narrative makes sense to me. I can understand it, and I can probably understand some of the similar regional locations. Your Bendigos, your Ballarats, your Latrobe Valleys, your Sheppartons and your Wangaratta's. I think there is a bit of a lifestyle play there. And you look at a lot of these areas, they have very tight vacancy rates at the moment. Really shows that people want to live in these locations. So just moving on, I want to look at property from the perspective of property being an asset. So ultimately, property is an asset with a cash flow. Within that equation, you have the purchase price of the property, the cash flow, and the yield or capitalization rate as sometimes referred to. So I wanted to start with running you through effectively how the cash rate kind of sets yields for assets. Probably the simplest way of thinking about this is thinking about having a high interest savings account with your bank. So, around 2011, the cash rate was, probably 5%. If you had a high interest savings account, maybe they would pay you 6% on the money that you have in that savings account. During the COVID era, when the interest rate was 0.1%, a high interest savings account, I'm not sure, would probably pay you like 1% per annum. And then when you think about the cash rate in relation to property and the yields of property, the yields within property are effectively going to follow the cash rate. So when the interest rate was, sort of 5% around that 2010 era, you'd expect that yields would be a lot higher than that COVID era when the cash rate was at 0.1%. Because over here in 2010, you're getting, maybe 6% on your money in a high interest savings account, and you're getting 1% on your money in that COVID era in your savings account. So if we then look at the H-tag extract of the gross yield for Bell Park, we can see that it does sort of broadly track the cash rate. So we have 2010 over here, we had a yield of around 5%. And then during that COVID low, we had a yield of around 3%. And then when the cash rate increased, so did the yield. Interestingly, we had a cash rate of 4.35%. The yield increased from around 3% to 4% within this suburb. And you'll notice that that yield is significantly tighter than in the 2010s when the cash rate was at a similar level. And I think that that's effectively the market pricing in the housing crisis. I think that a lot of people are seeing the fact that we can't deliver enough housing to keep up with the population growth within Australia. Rents are rising, and the government really doesn't have a whole lot of appetite to curb housing price growth, which is why I think the market is looking at yields and they're willing to accept a tighter yield than the early 2010s when the cash rate was at similar levels. We've also just had rampant money supply growth as well, so potentially that is feeding in as well. But interestingly, you can see in 2018, the cash rate was, maybe about 1.75%, which is lower than it is today, and we had a higher yield at that point in time. So at that point in time, effectively the market wanted a bigger margin on the yields in Bell Park compared to the cash rate. So finally, I just wanted to give you a bit of an example of how property price growth works. So this concept is from commercial property, but it also works in residential property. So if we're just looking at, say, a property in Bell Park, say it rents for $500 a week, which is $26,000 per annum gross, and we've got a 4% gross yield, then the value of that property is going to be $650,000. So you get there effectively by dividing $26,000 by the 4% gross yield to get to that value of the property. So there's a number of ways in which property can actually grow in value. So as I said previously, you're probably going to have a growth in incomes per annum of around, 2.5% in a standard year. So over time, you'd expect the median income to just slowly increase. And generally, you're going to see rents increase in line with the increases in income. So if the gross yield stays the same, but our rent increases from $500 to $550 a week, we see that a 10% increase in gross rent, the value of the property increases from $650,000 to $715,000. So over time, you're just going to have rent growth naturally. I'll just change that back to 500. But then if you're also in a situation where interest rates are dropping, you'd also expect the gross yield to drop as well. So if this gross yield goes from 4% to 3.5%, so you can see the value of the property increases from $650 to $740 thereabouts. And on the ground, this probably plays out as, sort of people outbidding each other for specific properties and the value of the property in the area increasing. But it's also effectively the market repricing this cash flow. So effectively what the market is saying is that it's willing to accept a lower gross yield on the asset. Just to give you another example, you look at Perth in like 2020. I think the gross yields within Perth were about 6%, and the gross rent was maybe like $350 per week in some areas. So you had these properties worth $300,000 effectively. And during this time, construction costs increased, circa 50%. Perth was very affordable. We had a lot of migration into Perth. Melbourne was the most locked down city in the world. We had an inflow of investors into Perth as well. So those gross yields were at 6%. And in some of the investor-heavy locations, they're at 4.5%. And these rents have also increased from like $350 a week to, $550 per week in some instances. So those $300,000 houses are now, sort of $640,000 houses. So just to conclude, I think there's lots of ways of conceptualizing the property market. These are just kind of the ways that I conceptualize the property market with my sort of valuation background. And I'm just one talking head on the internet. Take what I say with a grain of salt. Obviously nothing I say is financial advice. Feel free to join my Discord group. Just if you do join, please watch out for people scamming. There's lots of people impersonating me. And a bit of an announcement as well. I've sort of dropped down to part-time at my day job. and I've started taking on a few clients for buyer's agency. I have very limited capacity at the moment, given that I'm working 2 jobs, just been smashed recently, but potentially in a few weeks' time, I might be looking for a few more clients. I'm also pricing very sharply as I'm still kind of figuring out my processes and how I want to operate as a business. So yeah, if you're interested in that service down the line, I'll put a link to my website in the description of the video, and feel free to drop me a message. Thanks everyone.